Welcome back to Boni's Life. If you have been watching the charts lately, you might be feeling a bit like a sailor in a storm without a compass. We have seen Bitcoin drop from its all-time highs late last year, only to bounce back up, then get slapped down again by global events. Today, we are going to cut through the noise. We are going to conduct a deep fact-based analysis of the current crypto market as of late March 2026. We will look at the hard data, volume, market capitalization, the fear and greed index, open interest, and liquidations. More importantly, we are going to identify exactly what type of market we are trading in right now, and I will give you specific actionable strategies on how to trade it, whether you are a short-term scalper, a mid-term swing trader, or a long-term holder. Let us start by taking a hard look at the numbers. As of today, the total cryptocurrency market capitalization stands at $2.525 trillion. That is a 2.4% increase in the last 24 hours, with a 24-hour trading volume of $98.29 billion. Bitcoin is currently trading around $71,300, with a market dominance of 56.5%. Ethereum is sitting at $2,175. Now, to put this into perspective, Bitcoin is down roughly 18.5% year-to-date in 2026. We started the year near $87,000, and we are still down significantly from the all-time highs reached in late 2025. However, it is not all doom and gloom. We recently saw the total market cap surge by $60 billion in just 14 hours. Interestingly, while the broader market has struggled, stablecoins have hit a record market cap of $320 billion, and AI-related tokens are showing remarkable resilience. This tells us that capital is not necessarily leaving the ecosystem, it is rotating into safer harbors and specific narratives. Now, let us gauge the market sentiment. The crypto fear and greed index is currently sitting at 15. That is extreme fear. Just a few days ago, it was at 10. When the market is in a state of extreme fear, it usually means that retail investors are panicked, selling off their assets, and expecting the worst. But as the old saying goes, be greedy when others are fearful. However, we do not just blindly buy into fear. We need to look at the derivatives market to see what the smart money is doing. Looking at the data from CoinGlass, the total open interest across the crypto market is $111.59 billion, which is up 6.67%. The 24-hour futures volume is a staggering $198.29 billion. But here is the kicker. In the last 24 hours, we have seen $244.47 million in liquidations. The long-to-short ratio is almost perfectly split at 50.75% longs to 49.25% shorts. This high open interest, combined with significant liquidations, indicates a highly leveraged market that is prone to violent, sudden moves. When leverage builds up on both sides, market makers often hunt for liquidity, causing those sharp wicks up and down that wipe out over-leveraged traders. The funding rates on major exchanges like Binance and OKX are slightly positive, around 0.005%, which means longs are paying shorts, but it is not at an extreme level that would indicate an imminent, massive long squeeze. So, what type of market are we currently trading? Based on the data, we are in a high-volatility consolidation phase within a broader macro downtrend from the 2025 highs. It is a range-bound market characterized by extreme sentiment, high leverage, and heavy headline sensitivity. It is not a clear bull market where you can just buy and hold everything, nor is it a capitulation bear market where everything goes to zero. It is a trader's market. It is a market that punishes the impatient and rewards those who wait for key levels. To understand why the market is behaving this way, we have to look at the global macroeconomic landscape. The crypto market does not exist in a vacuum. Right now, the primary macro driver is the geopolitical tension, specifically the US-Iran conflict. Just recently, Bitcoin surged from $67,500 to over $71,400 simply because President Trump announced a 5-day pause on planned US strikes against Iranian energy infrastructure. The market is trading on headlines. When war fears escalate, risk assets like Bitcoin drop, and safe havens like gold surge. Gold is currently trading above $4,558. On top of geopolitical tensions, we have renewed fears of a trade war. Recent tariff announcements jolted global markets, causing Bitcoin to sink below $65,000 as heavy whale selling and steep ETF redemptions took place. Furthermore, US PMI data has reignited stagflation fears, slowing business activity combined with persistent inflation. This puts the Federal Reserve in a very difficult position. At their March meeting, the Fed held rates at 3.50 to 3.75%. While the dot plot shows one potential rate cut for 2026, 7 members are projecting 0 cuts. The next FOMC meeting is on April 28th and 29th, which could be Jerome Powell's final meeting before Kevin Warsh takes over as Fed chair on May 15th. Warsh is known for a sound money stance, which could mean tighter liquidity. Historically, Bitcoin has dropped after 8 of the last 9 FOMC meetings in a classic sell the news pattern. We also have massive crypto-specific events on the horizon. On March 27th, the SEC faces a hard deadline to rule on 91 pending crypto ETF applications covering 24 different tokens. On that exact same day, a massive $13.5 billion options expiry hits Deribit. The collision of a major regulatory decision with a massive options expiry is a recipe for explosive volatility. Let us dive into the technical analysis for Bitcoin to see where the price might go. Looking at the daily time frame, Bitcoin is consolidating between a key support zone of $68,970 to $70,000 and a resistance zone near $71,600 to $71,640. The oscillators are completely neutral. The RSI is at 53, the stochastic is at 42, and the MACD is slightly positive. The average directional index, or ADX, is at a very low 17, confirming that there is no strong trend right now. However, the moving averages tell an interesting story. The short-term moving averages, like the 10-day and 20-day EMAs, are sitting around $70,300 to $70,500, providing immediate support, but the longer-term moving averages are acting as heavy overhead resistance. The 50-day EMA is at $72,160. The 100-day EMA is at $77,982. And the 200-day EMA is way up at $86,228. The 200-week moving average, a critical long-term indicator, is currently down in the $59,000 to $61,000 range. What this technical setup tells us is that Bitcoin is coiling up like a spring. The higher lows on the 4-hour chart suggest that buyers are stepping in on dips, but the inability to break past $71,640 shows a lack of aggressive buying pressure. If we see a sustained breakout above $71,640, the next major resistance targets are $73,400 and then $79,200. Conversely, if the $68,970 support fails, we could see a rapid flush down to the $65,000 level and potentially deeper towards the 200-week moving average near $60,000. It is worth noting that the current price action dangerously mirrors the pattern we saw between November and January, which preceded the sharp drop from $90,000 down to $60,000. So how do we trade this? Let us break it down by time frame, starting with the short-term traders, the scalpers, and day traders. In a range-bound, high-volatility market, your best friend is the range itself. Do not try to predict the breakout. Trade the boundaries. Your strategy should be mean reversion. Look for long entries near the bottom of the range at $69,000 to $69,500. With a tight stop loss just below $68,500, take profits as the price approaches the mid-range or the upper boundary near $71,000. Conversely, look for short entries near the $71,600 resistance, with a stop loss above $72,200, targeting a return to the $70,000 level. Because of the high leverage and potential for liquidity hunts, you must use strict risk management. Do not use high leverage yourself, as the wicks will stop you out before the trade goes in your direction. Pay close attention to the 1-hour and 4-hour RSI. When it hits overbought or oversold extremes at these range boundaries, that is your trigger. For the midterm traders, the swing traders looking at days to weeks, patience is required. You are waiting for confirmation, not anticipation. The trigger for a bullish swing trade is a daily candle close above the 50-day EMA at $72,160, accompanied by an increase in volume. If that happens, you can enter a long position targeting the $78,000 level, with a stop loss placed back inside the current consolidation range. On the bearish side, if we see a daily close below $68,900, that is your trigger to enter a short position or hedge your portfolio, targeting the $65,000 support level. Given the massive events coming up, particularly the SEC rulings and the $13.5 billion options expiry on March 27th, it might be wise to reduce your position sizes heading into these dates. The volatility could easily trigger stop losses on both sides of the market before establishing a true direction. Finally, for the long-term traders and investors, those looking at months to years, the current market conditions present a classic accumulation opportunity, but it requires a strategic approach. With the fear and greed index at 15, we are in the zone where long-term bottoms are typically formed. However, the macro headwinds, stagflation fears, geopolitical conflicts, and a potentially hawkish new Fed chair mean we could still see lower prices. Your strategy should be dollar cost averaging, but not blindly. Set limit orders at key structural support levels. Have bids ready at $65,000 and have a larger tranche of capital ready if we revisit the 200-week moving average between $59,000 and $61,000. Do not deploy all your capital at current prices. Furthermore, pay attention to the rotation of capital. As we noted earlier, stablecoins are at record highs, and AI tokens are showing strength. Consider diversifying your long-term portfolio to include strong narratives that are surviving the current macro storm, rather than just holding legacy altcoins that are bleeding against Bitcoin. In conclusion, we are navigating a complex headline-driven market that is technically consolidating while macro pressures build. The data shows extreme fear, high leverage, and a critical technical juncture for Bitcoin. Whether you are trading on the 5-minute chart or the weekly chart, the key to surviving and thriving in this environment is discipline. Respect the levels, manage your risk, and do not let the noise dictate your actions. The market will eventually break out of this range, and when it does, the move will be significant. Be prepared, be patient, and trade smart. Thank you for joining me on Boni's Life. Stay safe out there in the markets.